answer is the what, the who, and the how of these tax reforms. So let's get this show on the road, Ugochi. Thank you. So in terms of our presentation, I've broken down the presentation into three, right? So we will talk about what are the changes that are, what are the direct tax changes that will impact banks and other financial institutions? What are the changes, what are the indirect tax changes? And then what are the tax administration changes that will impact? Then after that, I will give Ugochi the reins so that she can walk us through some of the key takeaways and provide a way forward. So let's get started. So what are the key changes that have happened from a direct tax perspective and will affect banks and other financial institutions? So one of the things is we now have what we call an effective minimum tax rate, right? So previously in Nigeria, we used to have minimum tax, but now we have what we call a minimum effective tax rate. And the minimum effective tax rate is basically Nigeria trying to align to the globe rules, which is basically the global base erosions provisions that are being pushed by the OECD, right? So what do this mean, right? It means that if you are part of a multinational group with a global turnover of about 750 million euros, or you are a Nigerian company with an annual turnover of 50 billion or more, then you will have to pay a minimum effective tax rate of 15%. This 15% is actually not the what we know as tax consultants, which is the assessable profits, but is actually the profit before tax, less any franked investment income, and unrealized exchange gains and losses. In respect of if we were to pivot to what that means for insurance companies, right? You're going to focus only on the profit before tax, less gross income and investment income from policyholders in the case of life insurance companies. Next, in terms of the direct tax changes, is the changes in the capital gains tax rate, right? And just to give a bit of background, the capital gains tax rate in Nigeria has been at about 10% for a very long time. However, we see that there is a remarkable increase, let's say 200% rise, because now the tax rate is going to be equivalent to the equivalent to the corporate income tax rate, which is set at 30%. Therefore, chargeable gains now are going to be included in taxable income. So this is significant. Why? It is significant because there has always been an arbitrage in terms of where people tend to push most of their income to capital gains as opposed to pushing them to what corporate income tax. And this arbitrage now is long gone. One of the other changes that we have seen, you may recall the Finance Act changes had prescribed that if there's a disposal of shares and the proceeds are less than 100 million, then those proceeds are exempted from minimum tax. So the current law changes that a little bit. It actually increases the threshold to 150 million and also prescribes a minimum chargeable gain of 10 million within a period of 12 months. So this is a welcome move because in the recent past, we've seen a bit of inflation, right? And with the inflation, it means that the chargeable, the proceeds of 100 million last year are not equivalent. So this increase in 50 million is a welcome move. One of the things, and perhaps just to give you a bit of flavor, is that there has been something that has been retained. You may recall that if the proceeds from the disposal of shares are reinvested, then the same would be exempt. So that's a welcome thing that, some of the good things that were there that had started with the Finance Act changes tax reforms have been retained. Now, one of the other things that has come into effect is gains from indirect transfer of shares of assets in Nigerian companies or assets located in Nigeria are now taxable. Let me just give you a bit of background here. Previously, if you had an indirect transfer of shares, right, let's say, for example, a holding company in maybe Mauritius, a holding company in Bermuda, or what have you, if you did a transfer of shares at the holding company level, there was no tax payable in Nigeria. However, this would mean that the gains are being taxed everywhere else other than Nigeria. So this change actually now helps to increase actually the tax base in Nigeria, because the indirect transfer of shares now are being taxed in Nigeria. Next, in terms of the key changes we see is there's something very interesting that has come out of these rules. What I can say is Nigeria is actually becoming a world-class global, a world-class country, right? And by saying that, what I'm trying to say is we are picking some of the changes that are happening at the global level and domesticating that within our local rules. So we do have one of the things that we call control foreign company rules, right? So the control foreign company rules are part of the action plan by the OECD on base erosion and profit shifting. So what this means is that if you have a Nigerian company and this Nigerian if you have a Nigerian company that or a foreign subsidiary that is controlled by a Nigerian company, and it appears that the profits of that foreign subsidiary can be distributed without causing any harm to that company, then those profits would be deemed to be distributed and taxed accordingly in Nigeria. This is important. Why? Because you find that you actually you're locking income out there and not taxing it in Nigeria. So the purpose of investments or the purpose of a Nigerian company investing in another country is to ensure that you are able to bring back the proceeds from that investment. So this is one of the things we're saying Nigeria is coming into the fore in terms of claiming its fair share of taxes from the global world. The other one from a controlled foreign company is if a non-resident subsidiary or a member of a Nigerian multinational group pays less than the 15 minimum effective tax rate, then the Nigerian parent will have to pay a top-up tax. Meaning that, so for example, let's assume you have a foreign subsidiary in Kenya and the effective minimum tax rate of that subsidiary is 10%. This means that with the current law, it empowers the Nigerian holding company to say that it actually empowers the Nigerian authorities to say that you paid a minimum tax of 15% or an effective tax rate of 10% in Kenya. However, you are required to pay an additional top-up tax of 5%. So those are some of the interesting rules that are coming on from what we call the CFC, control foreign companies. Another one, which is we in Nigeria, we have always seen that anytime an organization is looking for funds, they actually set up what we call levies. And these levies are levied on mostly the company profits. So in Nigeria, we have several types of levies, and in that they're principally considered to be corporation tax, right? So what are some of those things? We have tertiary education tax, we have NIDDA levy, we have the police trust fund levy, and Nasendi levy, right? Now, as part of these changes, all these levies are being all collapsed into what we call a development levy of 4% of the accessible profits, right? And it also, and with this 4% of accessible profits, it only covers, it excludes small companies and non-resident companies, right? So with a consolidated rate of about 4%, it would actually appear that there is some marginal reduction in these levies, because currently it's about 4.26% in all the similar levies that I mentioned about, right? Next, in terms of what are the other direct tax changes we see? So we do, I've discussed in quite a bit of length in terms of banks, right? But I think there are some nuances that are coming into the play when we're talking about other financial institutions. And one such nuance is the taxation of insurance businesses in Nigeria, right? So to be fairly honest, most of the provisions of taxation of insurance businesses in Nigeria have been largely retained. However, we do have some three key changes that would impact you guys that operate within this space. One, if you may recall, part of our Insight series on the non-resident companies, right? We discussed that profits earned by non-resident entities from insurance premiums paid in Nigeria are now subject to tax. This is significant. Why? You would find that basically, in order to take on the risk of to take on the risk, some of the balance sheets of the insurance companies are probably not big enough to accommodate these risks. So what happens? That you look for a non-resident company with a significant balance sheet that is able to take on these risks. And some of these risks are actually within risky businesses such as the oil and gas. So what you find is that there's a lot of premiums that is actually paid out of Nigeria in respect of risks that are located in Nigeria. So going forward, we expect to see that the premiums paid out of Nigeria to the non-resident companies are now being subjected to tax. In essence, we're saying that the source of that income is Nigeria and should be taxed in Nigeria. The other one that we see is dividend distributed as a result of actuarial valuations of unexpired risks will form part of the total profit. So let me explain here, right? So what are actuarial valuations? At the end of the year, actuaries would come in and value the risks that the company is holding, right? And at some point in time, based on their calculation, they might find that the company is able to distribute some of that profits of an expired risk. However, on the other hand, these were never taxed in the first place, right? So this change actually seeks to say that if there's any actuarial valuations of the unexpired risks and the same are distributed to the shareholders, then the same will form part of the total profits in Nigeria. The other one that we see is actually taxation of reinsurance companies, right? And this is perhaps I can say a boon to the reinsurance company. Why do I say a boon? Is because the reinsurance is one of the most capital intensive businesses in the insurance business. So what you find is that you are required to have a significant amount of paid up minimum capital, right? So one of the things the tax law is providing is if you are a reinsurance company and at any given point in time you have your fund is below the statutory minimum paid up capital, then 50% of your gross profits would be deemed would be taken as a deduction. Now, and that is for the purposes of ensuring that you're shoring up your minimum capital. On the other hand, if the fund is equal or above the statutory minimum paid up capital, then you would take a deduction of 25% of the gross profits as a deduction. Now, at this point, I would like to speak about the taxation of collective investment schemes, right? So for most of us, you'll actually realize that the new law extends former tax rules of the unit trust schemes. So there are different types of collective investment schemes as prescribed in the Investment and Securities Act. So some of those collective investment schemes will be mutual funds, will be unit trust, and real estate investment trust, right? So one of the things that this law seems to do is actually extend some of the former rules of the unit trust into the other schemes, right? Into the other collective investment schemes. So technically putting everyone, what I can say, pari passu or equal footing. Now, the other thing, one of the other things that we have seen is that dividends distributed by these schemes are tax exempt at the scheme level. However, the dividends and the income received by the shareholders or unit holders are taxable in their hands, right? One of the things I really would like to say is, and I think this is world class, is the existing provisions of the REITs, which is the real estate investment companies that are come through as a result of the Finance Act changes have actually by and large been retained. So what are those provisions? If you did distribute any rental income and dividends of the REIT, 75% of that is distributed within a period of 12 months, then that rental income or dividend income is exempt in the REIT. However, the same would be subject to tax to the unit holders or the shareholders, as the case may be. Well, this is not a specific change to the collective investment scheme there, right? Profits and gains from pension funds and their related assets are expressly exempt from tax. I think this is useful and it's important. Why? Because pension funds, if you look at the pension funds, it's basically all the rest of us in Nigeria contributing to the future of to our future, right? So by exempting this, then you're giving the pension funds an extra amount of money to be able to invest, right? So this is one of those changes that has been clearly put in the tax laws. I'll move on to the indirect taxes and the changes that impact you as banks and insurance and financial services, right? So one of the things is, I must say that I must commend the presidential, I must commend that committee on that came up with some of these changes. Why? Is because we are now moving away from what I can call a goods and sales tax to a real value-added tax. What do I mean? In a real value-added tax environment, you are allowed to actually claim your input VAT against your output tax. And the VAT you are allowed to claim is on both the services as well as fixed assets. Currently, as it is, you can only claim input VAT against the goods that you buy for resale. So, however, this is changing, and it actually is a boon to really service providers out there that incur a significant chunk of VAT on the services. Now they will no longer have to expense that, and they will have to be required to maintain an input-output VAT account, which would be able to track this. But there is a caveat here, right? And the caveat here is more strongly towards the financial banks and financial institutions. Why? Is because VAT is now restricted to VAT claimable on taxable supplies. Out there and globally, we know very well that for banks and insurance companies, most of their supplies are actually exempt. What do I mean by that? Interest income and mostly premiums would are quote unquote treated as exempt supplies, right? But you will find that and they form a significant chunk of the business of banks and insurance companies. However, they do earn a lot of money from commissions, and they also earn a lot of money from fees that they charge their clients, right? So one of the things that really the people charged with administering the VAT in banks and financial institutions have to be careful about is to be able to restrict the VAT claim on their taxable supplies. The next one is input tax can now be claimed within 5 years at the end after the end of the tax period during which the input VAT was incurred. Why is this important? I think this is important because you don't end up in a situation whereby that you're claiming input VAT 6-7 years, and that is already is within the statute period of the statute. It's out of the statute period of limitation. So the restriction of the claim within 5 years is to sort of bring it in line with the statute period of limitation. The other one is, well, one of the things being a practitioner in Africa, I can tell you is the revenue authorities are very good at collecting taxes. One of the things that they're not great at is paying refunds, right? So these tax reforms have actually put Nigeria into a world-class environment. Why? Because Nigeria Revenue Service, which is the successor to the FIRS, must process the refund within 30 minutes, within 30 days of the request of the taxpayer, right? And when the request has been made, the taxpayer may offset the amount against other taxes due, right? So it's an interesting one because it will be interesting to see the rules that the successor to the FIRS, the NRS, will come out in terms of offsetting these taxes, right? The next one is stamp duty on financial instruments. And one of the things I can say is if you look at, for example, the tax collection in Kenya, you will find that the amount of taxes that the banks and financial institutions pay or contribute to the exchequer is significant. And it's significant not from a direct tax perspective, which is this equivalent of the corporate income tax. It is actually VAT, stamp duty, and excess duty. So one of the things that we see is that the Nigeria Tax Act broadens the stamp duty to include additional financial instruments into to bring them into taxation. Because one of the things I perhaps hazard is I see that the view of the presidential committee is perhaps to ensure that a lot of more transactions there's a lot of contribution from stamp duty in terms of contribution to the exchequer. Also, one of the things to look out for is there have been updates to the insurance-related stamp duties, revising the rates and providing for new exemptions. One of the things that seems not to have been captured in my slide here is the form and the mode of stamping. All right, we do have and one of the oldest pieces of tax legislation as we currently speak in Nigeria is actually the stamp duty. Yeah, and I believe it's called the Stamp Duty Ordinance, right? So it's being brought into the 21st century, and by bringing the stamp duty into the 21st century, then you need to find a different mode of collection, and one of those things is the methods of denoting the stamp duty, and it's clear that electronic format of stamping is actually part of the things that we expect to see, right? In my view, one of the key things that I sort of want to pause and speak about here is the collection, right? If you look at the Stamp Duty Act and the schedule to it, right, you will find that a lot of the payers of the stamp duty is either the transferee or the insurance holder or the policy holder, as the case may be. However, is it efficient for the tax laws to expect that myself, for example, if I go and take an insurance policy for my household goods and I'm required to pay the stamp duty, how will I ensure that that document has actually been stamped? So perhaps this is one of those things that I see, or we hazard that the banks and financial institutions will probably be asked to be the collector of record, right? More or less like similar to what we see in terms of the reverse VAT as well as the withholding VAT system, right? Now, I would like to wrap up this presentation by talking about the tax administration. So what are some of the changes that are happening in terms of from a tax administration perspective that will impact banks and financial institutions? So just to give you a bit of flavor, right? For those responsible for managing the tax administration and compliance of tax or compliance with the laws for banks and other financial institutions, your jobs, I will say without fear of doubt, has more than doubled. Why? First of all, some of the key changes that have come in is that you will require a tax ID to open and operate a bank, insurance, brokering, or other financial institutions, right? So this means that as you will need to, as a rule of thumb, update your KYC procedures. This is significant, right? So at the very least, you need to work with your salespeople to ensure that you not only obtain the BVN, as the case may be, but obtain the tax ID, right? The other one that is an addition in terms of compliance is that banks and financial institutions are now required to submit annual tax returns to the tax authority, listing the names and addresses of all new and existing customers. If the transactions exceed 50 million in the case of individuals or 100 million in the case of corporate entities. Well, there's probably there could be controversy around here, but perhaps the question to ask is, if Nigeria is to expand its tax to GDP ratio currently that stands at 10 to 18%, then we need to widen that taxing. So this is one of those policy-driven changes that is actually being codified, right? One, on the other thing is specifically for insurance companies. So if you do engage the services of an insurance agent, a loss adjuster, or an insurance broker, then you need to include it in your annual tax return, showing the name and addresses of these service providers. What does that mean, right? Previously, this was never included. So it means that you will probably have to redesign, yeah, your tax returns, right? It also means that you will also have to redesign the data collection points to be able to file accurate annual tax return as an insurance company. The other one is the banks and financial institutions must use for recording and reporting taxable supply the electronic fiscalization system that is meant to be launched by the NRS. Let me just spend a minute or two on this electronic fiscalization system. So you may recall previously when I was speaking about the indirect taxes, I spoke about the ability for you to claim your input tax against your output tax, right? But for you to be able to do that and ensure that there is no reduction in terms of the VAT collected by the exchequer, then two things must happen. One, you must bring the VAT collection into the digital age. And how do you do this? You do this by ensuring that you have an electronic physical system that players will be able to issue invoices, and those invoices and the transactions are received at the same time in a near real-time perspective, or in a near real-time fashion, to the Nigeria Revenue Service. So what does this mean? This is significant. Why is it significant to banks and financial institutions? You guys run millions of transactions on a daily basis. So, and these millions of transactions are mostly sometimes run by machines, right? So for banks, you're thinking about your core banking system, right? And from your core banking system, then the transactions will flow into your ERP, right? So the question is, where do I place my, where will I put in information to be able to capture the taxable supply and ensure that I'm able to accurately record and report the information to the Nigeria Revenue Service. Now, one of the things that I have that was of interesting to the banks and financial institutions is additional obligations to the virtual asset service providers. Interesting, right? So I'm proud to be in Nigeria at this particular point in time, but because the reality of it is these tax changes have leapfrogged, and now we are actually being able to tax the virtual assets as well as the digital assets transactions, right? So what are the things, right? So who are virtual asset service providers? So if you're providing exchange, custody, trading, or issuance of virtual assets, then you need to register with the the Nigeria Revenue Service, who's the successor of the FIRS. Now, number two, what I can say is this, I would call it the confluence of two laws. The confluence of, one, fighting illicit financial flows, and the confluence of fighting tax avoidance. And it's significant. Why? Because you need to report large transactions and suspicious transactions to both the tax authority and the Nigeria Financial Intelligence Unit in line with the anti-money laundering laws. Significant. This is a confluence of two laws: fighting the illicit financial flows and tax avoidance. Also, as a virtual asset service provider, you need to obtain a SCUMU certificate, which is important for like every other person that has to deal with financial services transactions. The other one is you need to maintain customer due diligence and KYC protocols, including collecting and verifying customer identification. It's very easy to actually, if you're operating in a virtual world, not to know who your clients. But I think this is a welcome move, because then it forces you to know your customer. And you may recall, part of the things is you require a tax ID to open and operate a bank, insurance, stock brokering, and other financial services. So in addition to maintaining accurate KYC records, you also need to require them to get a tax ID. Now, one of the things that is of keen or that has surprised me in this tax legislation is the significant penalties for virtual asset service providers. They seem to be significant and stiffer, yeah, as compared to the other bank and other financial institutions. So some of these include 10 million if you are required to comply with something and you don't comply. The first month you pay 10 million, and then for every month that you are in default is 1 million. So you can quickly see how these penalties and interest could quickly ramp up, right? So I would like to stop here, Ugochi, and hand over the mic to you so that you can take us through the rest of the presentation. Thank you very much.
All right, thank you so much, Tim, for that very instructive and engaging presentation. In the last 35 minutes, we have had some extensive conversation around the introduction of the minimum tax rules for multinationals and big corporations. We've talked about the development levy on accessible profits. We've also heard you talk about the significant increase in CGT from 10% to 30%. We've talked about the stricter compliance and reporting requirements for financial institutions, spreading across from the banks to the stockbroking firms to insurance companies and other financial institutions. We've also heard about the mandatory digital VAT reporting requirements and the possibility for VAT recovery, and the broader application of the stamp duties. Also, as the last thing you talked about is in terms of the new rules and the framework for digital assets and virtual transactions. Thank you very much again for that session. I think at this juncture, we're going to look at the questions, some of the questions that have been dropped. A couple of questions came in during your session, showing that, we have actually, people have been listening, and they actually have some clarifications that they would require. So I would just go to the first question. So the first question is from Dio Obison. And he says, I would like more clarity on the amendments to the CGT, especially the profit threshold of 10 million. Tim?
Yeah, thank you very much for that question, right? So two things, right? If you look at that provision, there was a minimum, a threshold that previously existed. The threshold was that if your proceeds exceed, if your proceeds do not exceed 100 million, then there is no chargeable gain to be made, right? Or there is no CGT on it, right? However, the provision has been amended, right? The proceeds now the threshold has been increased to 150 million. Proceeds is what you are able to get, right? However, it is possible to actually have, let's assume that in any particular year, I acquired an asset, a chargeable asset for 140 million, right? And that asset, on the other hand, I sold it for 149 million. What does that mean? There are two things there. One, the proceeds I've received there is actually 9 million, meaning that the proceeds I've received is 149 million, meaning that I'm below the threshold of 150 million. Number two, the chargeable gain, which is the difference between the acquisition cost and the sales cost, is 9 million. So entirely that transaction is excluded from CGT. Now, another scenario to look at is a scenario whereby I bought an asset for 150 million, right? And I subsequently sold that asset for 160 million. What is in this particular scenario, the proceeds received from this transaction is 160 million, right? And since I had bought the asset for 140, then the difference is 20 million, right? So it means that this transaction, A, crosses the threshold, and B, I have a scenario where the chargeable gain is 20 million, which is above the minimum threshold of 10 million, meaning that I should subject this to tax. I hope that clarifies that question. Ugochi? Thank you.
Yeah, thanks a lot, Tim, for that deep explanation. You actually spent some time really explaining it. I have another question, which is from Godwin Momoba, and he says, please reconfirm that the development levy is 4% on accessible profits and not on PBT. Before now, Noseni, NIDDEF, and PFT should be the police trust funds and also the were on PBT and not on accessible profits.
Yes, I did. Thank you very much. Actually, Godwin, the development levy is now 4% on accessible profit, straight up, right? And just to, if you may recall, just going back to my slide, I indicated that there's likely to be a marginal rate in reduction, especially to banks and financial institutions, because the technical rate on this was about 4.26%. But if you're now subjecting it to the accessible profit, then it actually reduces it to about 4%. So yes, it's going to be on accessible profit and not the profit before tax. Thank you for that question.
Thanks a lot. We have another very good question in here from Adishola Etio. And the question goes, can I claim input VAT on fixed assets purchased in a financial institution?
Yeah, interesting question. I wouldn't have expected this question not to have passed. And the truth is, yeah, and I do expect there's some certain rules that have to come up. Yeah. So if you are a bank and a financial institutions, there are two things that you need to ask yourself, right? Am I producing taxable supplies? If the answer is I'm producing taxable supplies, then yes, I should be able to claim the input VAT on the fixed assets. However, there is also the risk that if I need to be able to compare between the quota of my exempt supplies versus the vatable or the taxable supplies. So this is one of those things that we do expect to see, that the NRS will come up with clear legislation, because you're likely to have a situation where the banks and other financial institutions are perhaps going to be in perpetual tax refund because they have incurred a significant VAT. For example, let's talk about the acquisition of maybe their software, or the acquisition of or the construction of a building, right? And then you end up with a significant amount of input VAT, right? But since the threshold of their taxable supply is usually lower than their exempt supplies, then they end up in a situation where they are in a perpetual tax refund. So I trust that the regulations and the rules that the FRS is going to come up with are going to clarify this particular point. Thank you very much for that question.
Thanks once again, team, for that insights. We have another interesting question that has come up more than once, and I'll just go straight to the question, and that is around, so the question, I've just tried to modify it, and it says, considering that the old tax laws are repealed, what will be the standing of the windfall taxes?
Oh, all right. Oh, well, very interesting question, Ugochi, and I wouldn't have expected this session to end without the windfall tax levy question coming up. So thank you very much. So one of the things that if you look at the windfall tax or the windfall levy, however you want to call it, the windfall levy was specific, and it was specific in saying that the taxes that would be due windfall levy would apply on the foreign exchange gain, on the gains of banks in respect of the financial years 2022, 2023, financial year 2024, and the financial year 2025. Now, Ugochi, if going back to your point where you say that when is the effective date of this Nigerian Tax Act, and we haven't seen the text, and based on the conversations by the chairman of the tax reforms, Mr. Taiwo Yedele, as well as the executive chairman of the successor to the FRS, Dr. Zaka Dediji, then we expect that the effective date of this tax bills is going to be the 1st of January 2026. What does that mean, right? It means that the laws become effective prospectively, not retrospectively, right? So if you think about the windfall levy was very clear and specific that it would impact financial years 2023, 2024, and 2025. So if the sunset is the financial year of 2025, which technically for most banks and financial institutions is 31st December 2025, it is expected that they would have to pay the windfall levy. Now, why do I see when we talk about taxation and fiscal laws, we actually say that tax and fiscal laws should not apply retroactively. It's a bit of an interesting one because the windfall levy actually applied retroactively, right? But what we know from the tax policy, the draft Nigerian tax policy, the tax laws are not supposed to apply retroactively, which is also in line with the Akugas case versus the FRS. So what do I see? I see a double-edged sword where that the Nigerian Tax Act will not apply retroactively to the transactions or retroactively to the final FY 2025. So yes, I reckon that there should the windfall levy is actually going to apply. Thank you, Ugochi.
Thanks, team, once again for that fantastic response. We have a next question, really good question from Victor Ebotemen, which says, what is the minimum tax for non-multinationals MNEs? So I don't know if you missed the first part of your presentation. Is there still a minimum tax left?
All right.
So yeah, so I have one. I think we can only.
Ugochi, I realized I was muted. Thank you very much. So, and I was speaking. Okay, so just to reiterate, the effective minimum tax rate provisions apply in two folds. One, you have the M&Es, where the revenue threshold is 750 million euros, and you also have the Nigerian companies that are not part of the M&E, and that the revenue threshold is 50 billion. So for both cases, the minimum effective tax rate is 15%. I hope that is clear, Ugochi. Thank you.
Yeah, thank you very much for that as well. I have one, I think we have space for just one last question. And I know it's an area that you really love. So the question is from Joseph Afolayo, and the question goes, please, can you explain more on the e-invoicing law and how a company can be compliant, especially for the SMEs?
Oh, that's a very interesting question, right? Just to go back, I think for me, what the first and foremost is to just give a bit of background on what e-invoicing is, right? So the Nigerian Tax Act provides for what I can call electronic fiscalization system. So the fiscalization of the system is to ensure that every transactions that you carry out, the revenue authority has an idea of the transaction, has an idea of the parties that carried out that transaction, such that there is any information asymmetry between the taxpayers and the revenue authority. That is what we call fiscalization, such that by the time if I go out there and procure a cup of coffee, then if they issue me a receipt, then that particular transaction, it actually is automatically transmitted to the revenue authority, and the revenue authority would know that Tim Siloma bought a cup of coffee for 1,000 naira at Ugochi and Co. Coffee Company, right? So that is electronic fiscalization. Now, so when we're talking about the e-invoicing on the other hand is a subset of fiscalization. What it actually means is that every invoice that is actually every invoice that is raised is tagged with the certain key features, and every invoice is given a unique ID, right? Such that at any one particular point in time, all the invoices raised in a particular ecosystem have a unique ID, and the revenue authority has the same information as the vendor, the buyer. So if you're looking at it, you have there is no any information asymmetry in that case. So one of the things that the FRS has done, and we are all aware, is that the FRS has in terms of how they have gone about the e-invoicing, they have decided no. The first thing is they're going to start with the large taxpayers, and then they're going to go down. The large taxpayers are taxpayers with a revenue threshold of 5 billion and above, and then once they have done, they'll pilot it at that level, and then they will go to the small and medium size enterprises down the road. So there are two things here, right? One, it's easy to. Why is it easy to fiscalize businesses that have a turnover of 5 billion and above? The answer is very simple. These companies have what I can call ERPs. Their ERPs have what I can call an API, an application program interface, where you can plug into the FRS merchant buyer solution, in which case, and you're able to transmit the invoices through that system. So they have systems, and it's easy to do that. Now, for the medium and small scale enterprises, and if I had a crystal clear ball on what the FRS are doing, I would hazard that they are going to go into what we call physical devices. Why do I say that I see a situation where they have physical devices? If you compare the economies of Kenya and the economies of Rwanda are no different from the economies of Nigeria. In terms of, Nigeria is bigger in terms of scale, right? But you also have, there is largely what I can call small and medium-sized enterprises, which is the equivalent of what you see in Rwanda and Kenya. So what have these guys done? So these guys have gone the route of ensuring that you have a physical device. So the physical device is that device that helps you actually raise an invoice that will bear the electronic signature, which is subsequently transmitted to the revenue authority. So that is what I see the successor to the FRS, the NRS, going. I hope I've answered that question, Ugochi. Thank you.
I said that this is an area that you're very passionate about, and then you had to be very elaborate about it. But thank you so much for taking time to explain that. But unfortunately, we're out of time and will not be able to take further questions. But we see the questions that have come in, and we'll make our time to respond to them to the individuals who have raised questions following this session. So thank you once again for all your thoughtful questions and active participation. I have really enjoyed myself. So team, from your presentation and questions, it's really clear from this session that 1 hour is not enough to unpack and do justice to all the issues concerning the banking and financial sector, services sector. How do you think that the listeners can take this forward? What's your call to action?
All right. Yep, Ugochi, thank you very much. I like to compartmentalize issues, right? And just also help have a clear roadmap in terms of understanding where you are and deciding what your future state would look like. Yeah. So what is the purpose of this presentation? You've clearly stated that 1 hour is not good enough, right? So what are the things that you need to know? Yeah. What part of this session is inform, inform your stakeholders and management so that you're able to let them know what are the changes. The changes are not, at some point in time, we were not sure whether these changes are going to come. But now they're here and they're here to stay with us. So what are we doing? Yeah, you need to be informed and sensitive your management. So what can we do to help, right? At the end of the day, we're at PwC, we are able to help you facilitate workshops and come up with awareness programs to be able to inform the various stakeholders, right? The next thing is you need to do what I can call a gap analysis. Define what is your current state and what your future state is going to look like, right? And then understand what are those things I need to put in place to get there, right? As a tax and reporting strategy partner, right, who has helped a lot of clients walk through this journey, one of the things is we call it a tax function effectiveness, right? But there are 3 things that you always need to look at when you're doing the assess. You need to assess the people, the process, and the technology. The reality of it is if you look at the requirements that are going to be put on the people that are responsible for reporting taxes, it's a lot, right? And this, a lot of, are you going to have a million spreadsheets? How are you going to make your work easier so that you're able to simplify your compliance? So you need to assess, right? So we can be able to help you prepare a holistic impact assessment with a clear action plan for your business. And the good thing is, you don't have to, well, these impact assessments can be daunting. So we've come up with a simple toolkit, that we are working with our clients and asking. By the time we're done with the questions, we can be able to come up with a clear roadmap of where you want to go, right? Next is a ticklet, reframing your tax strategy and setting an opportunity and coming up with a tax-free register, right? There are going to be many risks and there are going to be many opportunities, right? So how do you tap into the opportunities? How do you manage the risks, right? We can help you come up with a tax strategy as well as put in processes, right? Then once you have defined this, you operationalize and implement, right? You need to be able to understand who are your stakeholders. There's going to be a lot of stakeholders. One of the things I can say here is that these tax reforms and what you need to do have put the heads of taxes or people charged with tax governance at the center, right? So you need to be able to know you need to know the HR, right? I did not speak about what are the impacts to people, to your workforce. Obviously, there's going to be a significant impact. What is going to be the impact to the shareholders? What is going to be impact to the IT? You need to be able to engage all these people, right? And then finally, once you've implemented your tax strategy as well as your operations manual, then you need to be able to monitor, to be able to ensure that if there are any changes, you're able to quickly pivot to them. So yes, there's a lot to do here, Ugochi, right? So I like to stop there, but then I can tell you is at PwC, you have a pool of resources that can help you walk through this journey. And we are excited to walk through the journey with you.
Brilliant, brilliant. Thank you so much, team. I'm still on trainings and also equipping our people. I would hand over to Siri to take us on, to take take the slides on our upcoming trainings. Siri, are you there?
Yeah, thanks, Ugochi. Thank you, Tim, and well done. This was very well done. Very quickly, just to Tim's point, and Tim is from Kenya, by the way. So they've done the installation of their e-invoicing. So a lot of experience to get from there. The first training session or the second training session we're having is in Kenya, where we're going to have practical experience on fiscalization, and you get hands-on working with some of our Kenyan experts as well as our Nigerian experts on the tax reform. The first set of training we will have is from July to August, and it's on from policy to practice, adapting to Nigeria's fiscal landscape. And then right after that, we have the Kenyan one. So if you want to be in Kenya, come with us in November for the reframing of tax. And then July to August, we'll have the series of sessions in Lagos. We might also have some in Abuja. So stay tuned because we'll have several streams coming through once this follows. The links have been popped up in there, so you can register as well using those links, or you can scan the barcode that's showing on your screen right now. Thank you very much. Where's Tim? He's run away, or is Ugochi taking over? Ugochi, over to you. Yeah.
Thank you so much, Siri. If you don't know, Siri is one of our thought powerhouses. So really, you don't want to miss these sessions that are coming up. So thank you very much for this session. It's been quite an informative session. To our listeners, if you have any further questions, here's the contact information for our partners who are versed in all the areas that we have spoken on. Please feel free to reach out to us after the session. We also have additional sessions coming up on Wednesday. On Wednesday, we have the session on individual startup and family businesses. That's going to be at 10 a.m. on Wednesday. And we have the last session for oil and gas, utilities, and mining coming up on Friday, 18th of July. We really hope that, would have, people join all of you joining in the session for another yet engaging conversation on Wednesday. So on behalf of all the partners and the entire team, we wish to thank you once again for joining us today for this live session. We do appreciate your engagements and we wish you a productive day ahead. Thank you very much.
Thank you, Ugochi, and thank you to everyone that was able to join us. Really appreciate it.